Chapter 5, question 20. Well, in this question, we're going to have a situation that parent company sells inventory to the subsidiary company. Okay, so let's go ahead to look at the questions. So the question is, so for this big problem, we have three independent situations. First, let's have a look at the question 1, situation A. Assume that ProTrade sell Seacraft inventory at a markup equals to 60% of the cost. So ProTrade is the parent and Seacraft is the subsidiary. If there's a transfer from parent to the subsidiary, it means this is a downstream transfer. Each entity transfer was 114,000 in 2017 and 134,000 in 2018. So this transferred amount is the actual selling price or revenue amount for the parent company, or also the purchase price for the subsidiary. Of this inventory, Seacraft returned and then sold 52,000 of the 2017 transfer in 2018 and held 66,000 of the 2018 transfer until 2019. Okay, so this sentence means that every year there are some inventory not sold and hold to the following year. Then determine balances for the following items that would appear on consolidated financial statement for 2018. That is 3 accounts: cost of goods sold, inventory, and net income attributable to non-controlled interest. Normally, to solve this question, we need to, it's easier to do by prepare the consolidated entries. So we use those entries as adjustment entries so that we can get the final results. Okay. And for this question, there are involved, 2 periods are involved. One is 2017, the other one is 2018. So let's have a look at 2017's consolidated entry. We need to prepare 2 consolidated entries for 2017. One is entry TI. So entry TI is to eliminate the intra-entity transfer the sales amount, which is 114,000. So there's a sales. The reason we have this debit sales, credit cost of goods sold is, let's focus on sales. So when ProTrade sells Seacraft this inventory at 114,000 amount, a journal entry for ProTrade is to debit like accounts receivable, credit, sales. So 114,000 is the overstated revenue. If we look at if we look at this, consider these 2 companies as one entity, so this is intra-entity sales should be eliminated. So that's why we debit sales amount. And the other entry is the consolidation entry G, which is to defer the intra-entity gross profit. The reason is that for those remaining inventory, because they are not sold out, so we need to defer the potential profit associated with inventory to the following period or to the period when they are actually sold. Well, another purpose of this entry G is to correct the inventory's amount to its true amount. The reason is that when ProTrade sells Seacraft inventory at the markup, so which means that $1 inventory is actually sold at $1.60 to the subsidiary company. So even though there's no transaction with outside parties, but the value of the inventory increased from $1 to $1.06. It's overstated for kind of for no reason, and then this amount should not be reported to the outsider because that's intra-entity transaction. And the question is how we get how much is overstated. So we know that for 2017, they have 52,000 of the total of the 52,000 of inventory left, and then the question is how much of them are the overstated amount. And so the number is 19,500, and let me show you how we get that number. So normally to get this overstated amount, or to get this deferred amount of gross profit, we need to calculate what is gross profit margin. In other words, how much at what gross profit margin that the parent selling their inventory to the subsidiary here. And as to the margin, the basic equation for margin is that we use profit divided by total sales. And in this question, assume that pro-trade sales sell their inventory, assume the inventory's cost is $1 to pro-trade. So if the inventory profit cost to pro-trade is $1 and pro-trade need to sell it at a markup equal to 60% of the cost, then that means the selling price would be $1.60. So that's a markup of 60%. And then to pro-trade, the profit in this transaction is 60 cents, right? Because that's the markup. And if we use 60 cents divided by $1.60, that equals to $37.5%. And this is the gross profit margin. And then we are going to use this gross profit margin and times any remaining inventory. We can get how much of this any inventory overstated is 19,500, and this is also the amount of gross profit we need to defer to the following period. All right. So in the second year, first consolidated entry is star G, and this star G is related to the consolidation entry G in prior year, which means that in prior year we have deferred intra-entity gross profit that deferred to the following year. So now when it goes to the next year, then it is time for us to recognize this deferred profit, and the way we recognize it is to buy credit cost of goods sold. At the same time, we debit return earnings, and the reason is that we assume the parent company, so this is a downstream transfer, and we'll assume that the parent company is not using equity method. Well, if that's the case, then its return earnings include those gross profit that should be deferred to current period, but it is not, so we need to deduct it at this time. Okay, so the dollar amount here is the same amount we deferred in prior period. It will be 19,500. Alright, so the second entry is consolidation entry TI. Well, this is the same as in prior year, and we use this to eliminate this intra-entity sales amount. And intra-entity sales amount in the second year is here. It's 60. Okay, so it's 134,000. This is the intra-entity transfer in the second year. That's the amount we use here. Alright, so entry TI is complete, and the next one is the entry G again. Is because in 2018 there are still some intra-entity transfer and inventory not sold. Need to unhold until the second period next year. So here is going to be, we use this entry to defer the intra-entity gross profit to the period when they are actually sold. At the same time, we adjust the balance of inventory to its actual amount. And the way we adjust it is to use the remaining balance of the unsold inventory at this time. So inventory in 2018 is 66,000. Okay, so we use 66,000 and times the gross profit margin. The margin is still the same as in this year. It's not changing, 37.5%, and then it equals to 24,750. Okay, so this is the amount we need to adjust. Alright, so next let's come back to the questions. The question asking for the consolidated balance for cost of goods sold. For cost of goods sold, inventory, and net income attributable to non-controlling interest. So let's have a look at them one by one. First one is cost of goods sold. So cost of goods sold at the end of 2018 should be their current book amount, 410,000 plus 317,000. But do remember that we have a few consolidated entries that involves cost of goods sold. The first one is we have a credit balance of cost of goods sold in Stargy. So because that's credit, then we need to minus 19,500. So this is the cost of goods sold in Stargy. And then in entry TI, we also credit cost of goods sold by 134,000. So that also need to be deducted from the consolidated balance as well. And the last one is we deferred inter-entity gross profit by increased cost of goods sold by 24,750. Okay, so which means that we have three entries that involve cost of goods sold, and they need to be considered here. Okay, so then add them together. That equals to 598,250. Okay, so this is the consolidated balance of cost of goods sold. Next one is the balance for, okay, so we need to figure out cost of goods sold and inventory. So to get inventory, first we add the inventory's current book value, and then we're looking for whether there is any consolidated entry that involved inventory. Okay, so we see that in the consolidated entry G in 2018, we have a credit balance of 24,750. So we need to minus 24,750. So that involves inventory. And then it equals, so that's the only entry that involves inventory, and then which means that we only need to make this one adjustment. So inventory annual balance would be 489,250. Okay, so the last one is what's going to be the net income to non-controlling interest. And as to non-controlling interest, it only involves what's going to be the Seacraft net income, and non-controlling interest is going to get 20% of it, because non-controlling interest have a 20% non-controlling interest. So here, come back here, the net income to non-controlling should be 20% of the net income from Seacraft. We don't have net income from Seacraft directly, but we can calculate that. It's equal to the total sales, 600,000, minus Seacraft cost of goods sold, 317,000, and minus operating expense, 129,000. Well, that's enough. So here in this question, there is no annual excess amortization, and also because this is a downstream transfer, and all those adjustments related to the seller has nothing to do with the buyer. Well, if it is upstream, in other words, if Seacraft is the seller, then we need to make some corresponding adjustment related to its cost of goods sold or other expenses. But now because Seacraft is the buyer, and there's no adjustment related to this company. Okay, so and then it equals to 30,800. All right, so that's the solutions to A situation. Situation B. Assume that Seacraft sells inventory to ProTrade at a markup equals to 60% of cost. So in this situation, the main difference is that right now, subsidiary is the seller and parent is the buyer, and which means that this is the upstream transfer. Upstream. Each entity transfer was 74,000 in 2017, 104,000 in 2018. Of this inventory, 45,000 of the 2017 transfer were returned and then sold by ProTrade in 2018, whereas 59,000 of the 2018 transfers were held until 2019, and determine the balance for the following items that would appear on consolidated financial statement for 2018. Cost of goods sold, inventory, and net income attributable to non-controlling interest. Alright, so for 2017, this is the first year of transfer, and we are going to prepare two entries. The first one is entry TI, and we use entry TI to eliminate the intra-entity sales amount, which is 74,000. So debit sales and credit cost of goods sold. And second entry we prepare is consolidated entry G, and we use entry G to defer the intra-entity gross profit. This deferred amount determined by how much inventory are returned and then will be sold in the following period. And at the same time, this entry is going to adjust inventory back to its actual amount, because within this intra-entity sales, since the seller is going to sell it to the buyer at a markup, and this markup is kind of overstated inventory by this marked up percentage amount. Okay, and as to the amount related to the how much is overstated, we are going to use the amount of inventory unsold times the gross profit margin. And the gross profit margin here in this situation B is the same as in situation A. Since Seacraft is going to sell its inventory to ProTrade at a markup equal to 60% of cost, and which means that its profit is going to be assumed that there's a $1 inventory sold to the parent, and the profit will be 60 cents, and total sales will be $1.60, because cost Seacraft is going to sell a $1 inventory to ProTrade at $1.60, and so that she can the Seacraft can earn 60% as profit. This equal to 37.5%, and then we use 37.5% and times the remaining inventory at the end of 2017. That's going to give us the amount of the deferred gross profit, and that's how we get this the amount for this entry. Okay, so then let's move on to year 2018, and this is the year that's going to have impact on the consolidated balance of those accounts. So the first entry is entry star G, and we use entry star G to recognize those deferred profit in prior period. And the entry is we debit retained earnings and credit cost of goods sold. So by credit cost of goods sold, we reduce the cost of goods sold amount, and so that we can report higher profit. So that's how we recognize those deferred profit. As to why we determine debit retained earnings, it is because this upstream transfer and the subsidiary company is not going to update its retained earnings related to this overstated inventory overstated gross profit by itself, and then we need to deduct the amount by this entry star G. Okay, and then second one is entry TI. Similar to 2017, we use entry TI to eliminate this intra-entity sales amount, 104,000. And the third entry is entry G, and entry G is to defer the intra-entity gross profit related to those unsold inventory in 2018. So the calculation is similar, and at the end of 2018, we know that there are 59,000 of inventory retained, and times the same gross profit margin equal to 22,125. Okay, so that's how we get the amount for entry G in 2018. Next, let's move on to calculate the consolidated balance for cost of goods sold and inventory. So first, for cost of goods sold. So cost of goods sold is equal to the current book value, combined amount of book value, and then make some adjustment related to those three entries. So because all three entries have cost of goods sold involved. So for the first entry, star G is credit cost of goods sold, which means that we need to minus this amount from the consolidated total. A second entry is also a credit on cost of goods sold, which means that we also minus 104,000 as well. And third entry with debit cost of goods sold, that's going to increase the combined total. Okay, so the consolidated total should be 628,250. Next one is inventory. So inventory equal to their current book amount and adjust for any amount in the entries. So we only have one entry that involved inventory, that is entry G. So we credit 22,125, and then it equals to 491,875. Okay, so last one is what is going to be the net income attributable to non-controlled interest. Well, non-controlled interest have 20% of this C craft, and so that's why we use 20% and times the adjusted income of C craft. The reason we say adjusted income is because in this case it's upstream transfer, and then all those entries star G, TR, and G, they are related to the seller. The seller here is the C craft. Okay, so come back here. For C craft, we use is current sales minus is current cost of goods sold and minus operating expense. However, we need to make some adjustment related to its cost of goods sold. And the first adjustment is in the entry star G. In star G, we want to recognize those deferred gross profits, so which we deduct cost of goods sold. If we deduct the expense, which means that we need to add that amount into our net income. And then let's just go ahead and look at the G first. So in the entry G, we increase cost of goods sold to defer the profit. So we need to minus this amount from our current period profit. And then come back to this entry TI. So entry TI have both sales and cost of goods sold involved, and because that's the same amount, which means that the net impact is 0, so we don't need to worry about this 104,000. It's because, well, actually we can minus 104,000 in our calculation, but at the same time we also need to minus 104,000, so they cancel with each other, and so that's why we don't need to worry about this 104,000 in our calculation. Alright, so then we have this formula completed, and then the total net income allocated to non-controlled interest would be 29,750. Situation C. Portrait sells C Craft a building on January 1st, 2017 for 128,000. Although its book value was only 74,000 on this date. The building had a 5-year remaining life and was to be depreciated using the straight-line method with no salvage value. Determine balances for the following items that would appear on consolidated financial statement for 2018. Buildings, operating expense, and net income attributable to non-controlled interest. Okay, so in this transaction, this is an intra-entity depreciable asset transfer, transferred from parent to the subsidiary. So this is a downstream transfer. So from parent to the subsidiary. Okay, and for this type of transaction, normally we need to prepare two consolidated entries. The first one is entry TA. So entry TA is to eliminate those intra-entity gains related to, normally it's about a gain related or gain or loss related to this transfer. So TA means transfer of depreciable asset. And second entry is entry ED. It means excess depreciation. Okay, so let's look at the entry, what it looks like. So for this, in this situation, we debit gain on the sale and credit building. Why we have these two accounts here is, let's have a look at this transaction. So purchase sales C Craft the building, and so selling price is 128,000 and book value is 74,000. So in this transaction, there's 54,000 gain, right? That's a 50,000 gain for portrait, and on the book, a portrait is going to credit the gain on the sale. So that's why we debit this gain. And second is about the buildings. So its book value is only 74,000, but after this transaction, it goes up from 74 to 108. So the building value is overstated. So we are going to credit buildings to reduce its amount to its actual book amount. So that's why we debit the gain and credit building. Okay, so that's entry TA. And second entry is entry ED. So in this transaction, we debit accumulated depreciation and credit depreciation expense. And the reason we do so is that because this building is overstated, which means that there are going to be excess annual depreciation expense related to this overstated building. So they're using the straight line method, and the overstated amount is 54,000. So 54,000 divided by the 5-year remaining life, that's going to be $10,800 annual depreciation expense. That should not be there. However, because of this intra-entity transfer, and then they're going to recognize more expense than they should be. So we need to reverse these transactions by using this entry ED. So that's why there's entry ED. Okay, that's the consolidated entries we need for 2017, and then let's move on to 2018. So in 2018, we are going to have entry star TA. So this star TA is related to the prior TA, and in this transaction, we debit retained earnings and then credit buildings. Why we do so is because in the second year, there's no longer a gain anymore, because gain only in the year that this transaction happened. However, because this gain already been included in the return earnings, so we have to deduct this amount from return earnings to make this the correct one. And at the same time, we have also need to adjust the building to its actual amount, because building is still overstated. And how we get this 43,200? It is because after 1 year depreciation, so in the first year it's overstated by 54,000, but after 1 year depreciation, the remaining amount is 43,200. So that's why we debit return earning credit building by 43,200. That's how we got this number. And second entry is called entry star ED, and this is related to the prior ED. And well, because the parent company are using straight line method, which means that every year there's going to be the same amount of excess depreciation, and then we're going to prepare the same entries for this star ED. Okay, so that's why I have this debit accumulated depreciation and credit depreciation expense of $10,800. All right, so then let's move on to solve the question. This question asking for the consolidated balance for buildings, operating expense, and net income to non-controlling interest. So first, let's see what's going to be the consolidated total for buildings. So buildings should equal to its current book value amount, and then minus the overstated $43,200, because that's the second year. So we need to, this is a new amount we need to take care of. And then next one is to plus the entry star ED is $10,800. So that's related to the annual accumulated depreciation. Okay, and it equals to 530,600. So actually, this 43,200 is related to entry star TA, and 10,800 is related to the entry star ED. Okay, and then let's move on to operating expense. Operating expense is equal to the current book value of operating expense, and then minus $10,800. This is the excess depreciation, and then it equals to 292,200. All right. So last one is what is net income to non-controlling interest. So non-controlling have 20% of so controls have 20% of the interest in this company, and times the Seacraft net income will be 600,000 minus 317,000 and minus 129,000. So 317,000 is our cost of goods sold. 129,000 is operating expense. We do not need to make any adjustment related to Seacraft because in this transaction it's a downstream transfer, and we only adjust buyer's book, not seller's book. We only adjust seller's book, not buyer's book. So Seacraft is a buyer. Alright, so this equals to 30,800.